I'm Jennifer Hires, your host of the Lumberyard. Today, I have a special guest. I want to introduce you to Cody Daniels, founder of Builders Tax Group. So, before we dive into today's topic, Cody, go ahead and tell us a little bit about who you are and really what led you to focus on construction businesses.
Yeah, sure. Thanks, Jennifer. Happy to be here. Excited to sit down and talk taxes with a fellow CPA. Well, yeah, a little bit about myself. I've been a CPA in public practice for the last 13 years. Launched my own firm, Builders Tax Group, in 2024 with the focus of serving exclusively construction and, service trades type businesses. At my prior firm, I led the construction and real estate tax team there for several years. And when I decided to take the leap into entrepreneurship myself, I knew that this was the industry that I wanted to continue focusing on. I grew up around blue collar individuals. One grandpa was a union carpenter, another grandpa was a welder. My dad built the house that we grew up in. I had uncles doing electrical, plumbing, cousins doing HVAC and mechanic
Wow.
work and all that stuff. So, I'm kind of the oddball that went the desk job route, but I'm thankful and appreciative that I get to continue working with, those blue collar type businesses.
Yeah, absolutely. And then just to touch on it, and I introduced it, but the book that you wrote, and we'll talk about this a little bit later, is kind of what we're going to base this podcast on. But what is that book?
Yeah, so I wrote an ebook last year. It's called Laying the Foundation, and it outlines, what I consider sort of 10 essential tax strategies, specifically geared towards construction and trades type businesses. Certainly, some of the topics could be universal and applied to any industry, but the book itself is really written from the perspective of someone that owns and operates a construction business and focuses in on the strategies that I think are most important for them to consider in order to save some of that hard-earned cash that they've generated for themselves.
Yeah, absolutely. And I know your mission is to help contractors run more profitable businesses through strategic tax planning, outsource accounting, and fractional CFO services as well. What a beautiful mission that you do have, which leads me to my next question. Well, why should, guests that are listening to this podcast work with an expert, a CPA that is in the construction industry versus just going to any CPA?
Yeah, well, I mean, I think you kind of hit the nail on the head right there, Jennifer. Right, we're on a podcast, right, where the target audience is
Yeah.
is folks in the construction industry, probably even more specifically, people that own construction businesses. I think overall, specialization, expertise, niching, whatever term you want to use for it, that's just becoming more common throughout all facets of business. And I think the accounting profession is a little bit behind other industries. I think podcasting itself, I only listen to podcasts that are geared towards individuals running accounting firms as opposed to like general business podcasts. I only utilize software within my business that is developed specifically for the accounting industry. And you see that within the trades as well. There's
Yeah.
industry specific software. So why
Yep.
hasn't the accounting field caught up to that and started again, kind of developing these sort of boutique specialized expert firms? We're trying to be a little bit ahead of the curve on that in terms of the way we're building this firm.
Yeah, absolutely. So let's dive into a little bit. We're going to go high level with your book laying the foundation. And by the way, we will drop in the link to your ebook in the notes of the recording here. But let's go ahead and let's just start with the basics,
Yeah.
right? Financial statements, P&L, balance sheet, cash flow statement. Why are accurate financials such a big deal when it comes to tax planning?
Yeah, so every tax return calculation, every tax projection calculation out there for any business, the starting point is your financial statements, right? We start with your book income and we work through various adjustments in the tax law where tax law differs from book rules and regulations, and we adjust down to what your taxable income should be as part of that calculation. So if you don't have good financial statements to start with, it's kind of a garbage in, garbage out scenario, right? If we're starting with bad books, the majority of the figures that I'm going to be working with are bad, invalid numbers, and it's going to produce a bad tax outcome as we work through that calculation. So it's the foundation, not to, no pun intended, I guess, on the title of the book.
Yeah.
Accounting is the foundation for all of the tax decision making and strategies that we can implement.
Yeah. Yeah, absolutely. Do you have any examples of, where clients, they would have missed potential deductions and where you were able to help them?
Yeah, so actually, just earlier this year, I was working with a real estate developer, former contractor that's kind of moved more onto the development side of things, and they sold a building at the end of 2024. So we're working
Mhm.
through the tax return earlier this year, and yeah, I worked through the calculation. And I say, hey guys, I'm coming up with a $600,000 gain on the sale of this property. As a result, you're going to owe X dollars in taxes.
Yeah.
And they say that doesn't pass the smell test, Cody. That something about that seems off. Like, we know we've put a ton of money into upgrading this building, and we've had to contribute dollars personally beyond the construction loan that we received.
Mhm.
We think we lost money on this deal. And I said, okay, guys, let's go back to the beginning. You bought this property in 2018. Give me all of your historical tax returns. I know they don't have financial statements because I started the preparation of the 2024 tax return utilizing bank statements only. So
Mhm.
already we're off to a not so great start. We're just working off of bank statements. We don't have true financial statements. Long story short, review the historical tax returns. We can see that there was an increase to the construction loan in 2020, no subsequent capitalization of any improvements. The prior tax preparer didn't dig deep enough, didn't ask questions. They knew that the balance in the loan increased. They didn't ask, where did the money go? They just push it through distributions.
Mm.
So it wasn't treated as a capitalized cost. It wasn't part of the basis of the building that they sold. It was as though they received that cash themselves.
Wow.
So we were able to work through it. I produced the appropriate documentation, draw statements from the title company, historical record of where the actual dollars from the construction loan went. And we were able to identify roughly $900,000 of
Oh my
missing
gosh.
costs. So it's a $900,000 flip in taxable income. We go from a $600,000 gain down to a $300,000 loss, which is in line with their expectations.
Sure. Yeah.
And ultimately, obviously has a huge six-figure impact on their tax bill.
Mhm. That it does. That it does. Yeah. I'm a CPA, but I call myself more of a recovering CPA. I don't
Sure.
really practice anymore. I went more in the ERP side of things. But I know a common mistake when it comes to financials is mixing personal and business expenses. Can you
Yeah.
elaborate on this?
Yeah, we definitely see that, especially kind of with like newer startup businesses. You have individuals that they're just getting things up and running. Eventually, they're going to get the business bank account set up, but they're probably using personal funds to get things started. They may not take the time to go get a business credit card. So they may be running business expenses through their personal credit card. And if we don't have a pretty clear separation of those business and personal expenses, it's not to say that we can't comb through it, and identify
Hmm.
the items that are personal versus business, but it's going to cost you. Like, I mean, there's going to be a cost associated
Yeah.
with either hiring somebody to do that, or for you personally, there's going to be a time cost for you to go through and start to separate out those expenses. And again, very much like this example here with this developer, like, if it
Yeah.
doesn't run through the business account, there's a greater than, there's a greater chance that we're going to miss it on our end, and we're not going to be
Yep.
able to identify those expenses, and you're going to overstate your income, and you're going to pay too much in tax, simply because, like, we don't know what we don't know, and we can't go through all your personal expenses and identify that expense that was a business expense versus your daycare payment, or your rent payment, a mortgage payment, whatever.
Hmm.
So it's really important from day one to get that separate business checking account set up, get a
Yep.
separate business credit card set up, and I guess on the flip side, don't run personal expenses through the business either.
Yeah.
Once you get those two things set up, just keep them separate. Don't commingle the funds. Keep your distributions clear to yourself. However,
Yep.
you're compensating yourself as the owner of the business. take those dollars out and then use those to pay for your personal expenses. Don't pay for the personal through the business account. It just, you don't want to muddy those waters.
No, no, absolutely not. No. Good. I think that this was a good high level overview of the chapter. So, the chapter that we were just referencing is ensure your financial statements are accurate and up to date. So, if you want to dive in a little bit more, go ahead and download that ebook and learn more about financial statements. So, let's go to another chapter. This chapter is going to be evaluating your entity structure. So, Cody, tell me, how should contractors approach their entity structure? Let's say if they're just starting out or have been in business for many years.
Yeah, so I guess before I dive into that, Jennifer, I'll just real quick, I kind of want to talk you through my mindset in terms of ordering the chapters here,
Sure,
and why we're
please.
going through this in the order that we're going through it.
Yeah.
I tried to kind of dual rank each strategy based on two things. Number one, like the importance to the overall kind of dollars and cents aspect of things, like what strategies have the greatest return on
Mhm.
like the investment of getting them correct. And then number two, what is sort of the like chronology of your business, right? So if you're just starting out, like getting good financial statements, chapter one, like that is the most important thing that you can do starting out. It's
Mhm.
also going to have the greatest benefit to you because it's the baseline, it's the foundation, like we said, for every tax calculation that we're going to do. Moving into chapter two, or strategy two, your entity structure,
Mhm.
it's also it's a decision that you make early on in the life of your business. So it's one of the
Mhm.
first decisions a new business owner has to make, is how am I
I
going to
do.
set up this business? And it's not a set it and forget it, decision, right?
Mhm.
It's something that you need to continue to evaluate. So it's not just for startups. It's a consideration you need to evaluate throughout the life of your business. As your business goals change, as your business evolves, your entity structure may need to evolve with it. So that's, again, just a little bit kind of behind the scenes as to why I've ordered these things the way that I have. And also this choice of entity structure has a huge impact on the dollars and cents aspect of your ultimate tax bill.
Yeah, it does. It does. Absolutely. Can you dive more into that? What the right
Yeah.
structure? Mhm.
Yeah. So really, for tax purposes, there's four different structures that a business owner can choose from. There's a sole proprietorship,
Mhm.
there's partnership, and then there's an S corporation or a C corporation. You'll notice I didn't say LLC. I think, LLC is the term that everybody throws out there on social media. An
Yep.
LLC is not an entity type for tax purposes. It is a legal entity type, and depending on the elections that you make for that LLC will dictate the entity type for tax purposes. So your LLC
Mhm.
could be one of any of the four entity types that I mentioned there.
Good to know. Noted.
So, kind of to dive into the different entity types a little bit further, provide a little background on them.
Yeah,
Yeah,
please.
I always start with sole proprietorship because I think that's where most new businesses start out. It's an easy to set up structure. You don't actually have to file anything with like a Secretary of State or other government agency to formally organize this business. You can just go out there and start running as a sole proprietorship, and you report all of the activity from your sole proprietorship directly on your individual tax return. So from a filing perspective, it's super easy. Again, that's why you see it commonly with startups. The
Mhm.
downside, one of the main downsides to a sole proprietorship, is as you start to grow, as your profitability increases, all of your income is subject to the self-employment tax, which is
Mhm.
essentially a replacement for Social Security and Medicare that you're paying as a sole proprietor business. So it's an additional 15.3% tax
Mhm.
on top of the income tax that you're paying. So it can start to become pretty burdensome over time.
Okay.
And that's really where you start to see a potential shift as your business grows into one of the other structures.
Got it.
So, kind of moving through the book and the other structures, we have two different types of flow through businesses: partnerships and S corporations. There's a lot of similarities between the two, in that you, as an owner within this business, your income will pass out to you and be taxed on your individual tax return via a Schedule K1. So partnerships and S corporations, they don't actually pay tax at the federal level, at the business level. They're considered
Okay.
they're considered pass-through entities where the income flows out to the owners and is taxed on their individual tax return. Kind of a change as far as I think a lot of business owners aren't maybe used to that when they make that change. The requirement to do estimated tax payments and things like that can catch people by surprise. So it's important to know how the choice of entity impacts your individual tax liability, because you could be surprised and end up owing tax later in the year based on the profits of that company, whether or not you've received any actual cash payout from the business.
Oh, okay. Okay.
So some of the differences between the two: partnerships are very flexible. You can especially allocate income and deduction between partners. You can have kind of special allocations of distributions based on the way your partnership agreement is written. So it provides a ton of flexibility. Again, one of the downsides here is if you're actively participating in the business, your income is very likely going to be subject to that self-employment tax, just like with the
Yeah.
sole proprietor structure. So I will say, just kind of in my professional experience, most of the contractors I work with, I see that they eventually move into the S Corp structure because it still provides that kind of flow through structure of a partnership, but you can pay yourself a reasonable compensation through that entity, and you can, mitigate or reduce the amount of the Social Security and Medicare tax that you're paying
Okay.
based on the compensation. Any income that flows out to you on your K1 that's above and beyond your compensation is not subject to that self-employment tax.
And that is why we hire you, because you know how we can save on taxes through switching different entities then.
Yeah, and that's a very common kind of path for us is we work with
Yeah.
these sole proprietors, and once you hit, it's going to vary, based on your business and kind of where your profitability is in your maybe want or need to take on things like payroll filings and additional corporate filings and things like that. But at a certain point, most businesses outgrow that sole proprietorship, and we tend to advise them to move into an S corp structure. I did that just a couple years ago for a client, and right away, annual tax savings in the range of about $10,000 to $11,000 just by
Wow.
switching that button over to the S corp status. And that's going to be annual savings, right? That's going to be every single year that they're going to save that, $10,000 to $11,000. As they start to grow the business and it becomes more profitable, those savings are going to continue to compound, and it becomes then a $20,000 savings, a $30,000 savings as their
Yeah.
business continues to grow.
And was that the husband and wife who were running the business together and they were filing as a sole proprietorship?
Correct. Yeah, they were a husband and wife, actually dual real estate agents. So
Hmm.
very successful kind of husband and wife real estate team. The business was set up as a sole proprietorship that the wife owned originally. So they were paying that self-employment tax, and we were able to convert them to an S corporation, set them up with a reasonable compensation as required by the IRS, but essentially cap the amount of income that was subject to the Social Security and Medicare taxes, so that anything on top of that's not subject to the 15.3% tax that I mentioned. And that's where the tax benefits are coming from. And
Yeah.
apparently, on a side note, and I will not pretend to be an expert in this at all,
Yeah.
but a big reason that they came to me initially was that going through this entity restructuring and moving to S corp allowed them to get a better health insurance plan. Again, I can't comment on why that
Mm.
worked out for them, but
Yeah.
that was the story that I was told, and so there were other non-tax benefits to them making that change as well.
Yeah. No, I mean, it all, it's a domino effect, right? So again, we get you to help out in switching over sole proprietorship then to an S corp, and then it goes from there. What about for companies who are structuring for growth? Like I hear it in my
Yeah.
industry, right? Like we plan on growing, scaling and growing, bringing in potentially partners. Any advice on that?
Yeah, I mean, I think that's something that you need to have a conversation with somebody informed in these matters about, your CPA and attorney, probably a joint combination of different providers to talk through that, depending on exactly how you want to broach that subject. A partnership may be a good opportunity there.
Hmm.
There's a lot of flexibility, like I said, with how you allocate things and setting up sort of different tiers of waterfalls and income allocation. So the partnership is certainly a good structure for bringing in outside investors. So is a C corporation. You can bring in outside investment there. I've started to see within the construction industry, not to again jump ahead too far into the book, utilizing a C corporation to set up an ESOP so that you can get employees skin in the game and have a bit of the ownership through an ESOP, which again is, you need a corporate structure to utilize that. So yeah, it's definitely something to have a conversation about, because it's not a one size fits all answer. You'll note in the book, I don't actually recommend anything to anybody. It's all just food for thought. It's all just, here are choices that are available to you, and here's when some of these choices may be beneficial versus not beneficial. But you really do need to sit down and talk through this with somebody, because everybody's tax situation is different and unique. And one slight variation in your situation versus, your buddy's situation can have a totally different recommendation or outcome as far as how we want to move forward with things.
Yeah, it's good advice, Cody. Ready to talk about the next chapter?
Yeah, sure.
Okay. So this chapter is assess your accounting methods. So we are talking cash, accrual, completed contract, percentage of completion. Sounds a little technical. So
It's very
what
technical.
does this really mean for a contractor?
Yeah, and I think I sort of preface it in the book as like, this is the most complicated strategy that we're going to dive into here, and this is an area where I even see accountants struggle with conceptualizing this, because this is, of all the strategies in the book, this is the most, I would say, specific to the construction industry.
Okay.
Most business owners know that they have a choice between cash and accrual as far as accounting methods go. Accrual essentially meaning that, when you bill your client, you're going to recognize it as revenue. And then when you incur an expense, you're going to recognize that expense. It has nothing to do with when you receive cash from your clients, and it has nothing to do with when you pay expenses out to your vendors. Cash is obviously the exact opposite. You recognize revenue when you receive cash, and you recognize expenses when paid. Within construction, you touched on it. We have other methods available, such as completed contract, percentage of completion. Even within kind of those buckets, there's some other sort of more nuanced, specific methods available. So it does get very complicated, because instead of deciding between cash and accrual and only having two potential options to move forward with, you could have upwards of 4 or 5, maybe even 6 methods that you're applying on your tax return. And different jobs or job types could be treated under different methods. So a home contract may have a different method than like a commercial building, an office building, or a manufacturing facility or something like that. So even within like one kind of contractor's schedule of WIP, like, you could be applying different methods to different types of jobs, and it could get very, very nuanced and very complicated very fast, just depending on kind of the types of work and the types of jobs that you're moving forward with.
Right. And you mentioned WIP, right? And immediately my brain goes to overbilling versus underbilling and calculating that out.
And maybe, I don't know, maybe we should, to sort of circle back to chapter 1, just talk about like, what are overbillings and underbillings, and how do you account for, jobs for a contractor? I guess very simply put, for book purposes, most contractors should be maintaining their long-term contracts on a percentage of completion basis. And what a long-term contract is it's any job that spans tax years. So it doesn't have to go more than 365 days. You could have a job that starts in November and ends in February. That's a long-term contract, because it spans tax years, it spans reporting periods. So maybe just like a very basic example, just to kind of educate everybody on how this should be done. Let's say you have one job, it's $100,000 job. You expect that you're going to incur $80,000 of costs to complete the job. You're going to have $20,000 of profit on it, right? At the end of the year, let's say you've invoiced your client $60,000. When you do that, your accounting system, is going to recognize $60,000 of revenue. When you send out that invoice, you're going to have $60,000 of revenue show up on your P&L.
Mm-hmm.
Let's say at the end of the job, you've only incurred $40,000 of the total $80,000 of costs. So
Mm-hmm.
your job is 50% complete.
Mm-hmm.
You should have only recognized 50% of your revenue. So
Mm-hmm.
50,000, not 60,000. So you're overbilled on that job by $10,000.
Yeah.
So to adjust your books, for the percent complete that job is actually complete, you're going to need to reduce your revenue by $10,000, and you're going to need to book an overbilling on your balance sheet of that $10,000. So
Mm-hmm.
it's a very basic example of how you apply the percentage of completion method of accounting. But imagine, you do that for 100 jobs on your schedule,
Right.
on your WIP schedule.
Right.
You got to go through and you got to go through and kind of make those over under billing analyses and update your financials accordingly. That's the book side of things. On the tax side of things, we have a lot of opportunity to utilize other methods to defer income. This is not like a permanent tax savings game, like the entity structuring where you can move from one entity structure to another. You can achieve permanent tax savings through that.
Mm-hmm.
This is purely a timing strategy. It's purely kicking the can down the road so that you can save $1 today. And we all know that $1 today is much more valuable than $1 a year or two down the road.
Yeah.
So we can implement, these other strategies. And I have a couple examples, just over the years. Back in, I guess it'd be 2018, because the Tax Cuts and Jobs Act was passed at the tail end of 2017. So that was kind of the first Trump tax bill. And obviously
Mm-hmm.
we're going through, what'll be the second Trump tax bill right now. The House is actually debating that, I think, today, as of the day of this recording. So we may have some updates there as to upcoming tax law changes, but we're not going to talk about that until the bill's final. But
There you go.
back in 2017, the first Trump tax bill was passed, the Tax Cuts and Jobs Act, and one of the provisions there increased the gross receipts threshold for the definition of what is considered a small business. So prior to that bill, the threshold was $10 million in average annual gross receipts for the past 3 years. When that bill was passed, it upped the threshold to $25 million, and it indexed it for inflation. So I think today, 2025, the threshold is now $31 million, I believe.
Wow.
The reason that matters and why that's beneficial is it significantly increased the number of contractors that could utilize methods like cash or like completed contracts on their tax return and move away from the requirement to report their tax return on percentage of completion basis. So we saw a huge opportunity when that bill was passed, and I can probably think of half a dozen or more examples of contractors that fell between that 10 and that $25 million threshold, where we were able to convert them away from percentage of completion over to like a cash method, and defer, I would say, depending on the client, anywhere from 6 to maybe even 7 figures of taxable income into the future. So again, we're kicking the can. It's not a permanent savings, but there's huge benefit to kicking that can down the road.
Yeah, no, absolutely. Cody, this has been great. What's the one thing you'd want every contractor listening today to take away from this conversation between us?
Yeah, I would say don't wait on tax planning. Just, download the book, take some time to run through it. It's a meaty book. It's over 50 pages. It's not your typical, one-page lead magnet that people put out there and it's got one sentence on each strategy. Like, no, this is a deep dive into the strategies. I don't expect any construction business owner to become a tax expert in this, but I wanted to put out something that was incredibly detailed and incredibly valuable so that you could take this and not learn how to do your own tax return, but go to an expert and have a conversation about these strategies, about these opportunities, and take advantage of them before it's too late, right? It's July right now when we're recording this. If you come to your CPA, your tax preparer in February, March, April of 2026, it's too late. Get started now. I start with all my clients, at least in Q4, we're doing tax planning for everybody. Some clients we start earlier in the year. We're starting maybe even potentially now, depending on the industry that they're in and the situation that they might fall into. So I think, yeah, the one takeaway is, take advantage of the free book, download it, get started today. Don't wait. Contact an expert. Doesn't have to be Cody Daniels at Builders Tax Group. It can be your CPA that you've had a long-term relationship with. But we exist to help you, but we can't do it if you wait until the year's over.
Exactly.
Work with somebody proactive, be proactive. Taxes are one of the largest expenses any of us are going to pay in our lifetime. So don't make it an afterthought. I know this is a busy season for contractors. Everybody's busy out there running jobs, but find some time and take control of this liability for your business.
Yeah, absolutely. And then I will put a link to Laying the Foundation again, where you can download this free ebook. How about if they do want to learn more, they do want to contact you, Cody? How would somebody get a hold of you?
Yeah, I mean, we could post like the contact us page for the website directly in the show notes. They can certainly go there. There's a short questionnaire to fill out just to help me learn more about the business so I can come into any conversation well informed. If you want to contact me kind of on a more personal level, LinkedIn is where I'm most active on social media. I don't really do the X or anything, Twitter, whatever you want to call it. I'm not really active on any of those platforms,
Yeah.
but pretty active on LinkedIn. So add me on LinkedIn, shoot me a DM or contact us through the website, and happy to strike up a conversation.
Awesome. And Cody, it's been such a pleasure. Will you come back to the show and continue this?
Yeah, I would love to come back. This has been great. Thanks, Jennifer.
Okay, we'll go through some more chapters. But again, if you want to reach Cody Daniels, founder of Builders Tax Group, we'll put that link in there and you can also be found on LinkedIn as well. Cody, again, absolute pleasure. And I look forward to our next recording.
Yeah, likewise. Thanks, Jennifer.
All right, take care.